PAXG and Mexico are sounding alarms. Why silver could spike higher before Western markets even opened. A quiet signal appeared. Gold-backed crypto, pricing $50 above Friday's close. On a Sunday night, then came Mexico. Military on the streets, airspace shut down. The world's single largest silver producer, in crisis. And deep inside the COMEX, a short position so large, so historically unprecedented, that it has never been seen before. Not once. In recorded market history. 3 alarms, sounding at the same time. What happens when they all converge on the same Monday open? That answer changes everything. Welcome to AYU and AG, where gold and silver speak, and we translate. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't cancel your morning newspaper just before the biggest headline of the decade. Hit that subscribe button. Keep this channel close and tell us something. Where in the world are you watching from right now? Drop your city, your country, in the comments below, because what we're about to discuss affects every corner of it. Every Sunday night, while most people are watching television or preparing for the week ahead, a small group of market watchers sits quietly in front of their screens. They are not waiting for Monday morning news. They are watching something else entirely, something that most people do not even know exists. On this particular Sunday evening, those watchers noticed something unusual. PAXG, a digital token backed one-to-one by physical gold, that was trading at a $50 premium above Friday's Western closing price. Gold had closed the previous week around $2,498, but PAXG was pricing significantly above that number. Before a single Western institution had opened its terminal, before a single futures trader had placed a single order, before CNBC had aired its first segment of the week. Now, most people hear this and ask a simple question. What exactly is PAXG, and why should anyone care? Here's the answer. Traditional gold markets, futures, spot, and exchange-traded funds operate within specific trading hours. When those markets close on Friday evening, they stay closed through the weekend. But crypto markets never close. They run 24 hours a day, 7 days a week, 365 days a year. Gold-backed tokens like PAXG essentially fill that gap. They allow market participants to express a view on gold during hours when the traditional gold market simply does not exist. So when serious money begins bidding up a gold-backed token on a quiet Sunday night, that is not random behavior. That is a message. It means that somewhere in the world, informed participants are positioning themselves before the institutional market opens. They are not reacting to Monday's news. They are anticipating it. The $50 premium that appeared that Sunday evening was not noise. It was the financial equivalent of smoke rising before anyone had officially reported a fire. And experienced observers know one fundamental truth about smoke. It does not appear without a source. What was that source? The answer was not hiding in a single headline. It was sitting at the intersection of 3 separate developments, each serious on its own. But together they were pointing towards something that the broader market had not yet priced. And the first of those 3 developments was unfolding inside a country that most silver investors never think about, until the moment it is already too late. There is a country that quietly powers a quarter of the world's silver supply. It does not make headlines for its mining operations. It does not appear in most financial briefings. It does not trend on business news channels. But remove it from the global silver equation, and the entire market feels the weight of its absence almost immediately. That country is Mexico. On the same Sunday evening that PAXG was flashing its $50 premium signal, something was unfolding inside Mexico that had nothing to do with markets, and everything to do with them. Military units had been mobilized across key regions. Airspace had been restricted in parts of the country. Flights had been canceled without clear public explanation. And at the center of it all, a significant operation had reportedly eliminated one of the most consequential cartel figures in the country's recent history. Most financial analysts looked at that headline and saw a law enforcement story, a political story, perhaps a diplomatic story between Mexico and the United States. What they did not see was a supply chain story. Here is what the data actually shows. Mexico produces approximately 1 in every 4 ounces of silver mined anywhere on Earth. Not 1 in 10, not 1 in 20, 1 in 4. That single statistic transforms every significant disruption inside Mexico from a regional news event into a global commodity variable. Road blockades, slow logistics, airspace restrictions, delay shipments. Military presence near mining corridors creates operational uncertainty for mine operators who must calculate whether their workers can move safely, whether their equipment can be transported, and whether their output can reach international markets on schedule. None of this produces an overnight collapse in silver supply. Mining does not work that way. But here is what experienced commodity analysts understand that casual observers do not. Physical commodity markets do not wait for supply to actually disappear before they reprice. They reprice on uncertainty. They reprice on the possibility of disruption. And in a market that was already running structurally tight, where physical demand had already been outpacing paper positioning, where Shanghai premiums had already been signaling that real buyers were paying above market prices to secure actual metal, even the shadow of a Mexican supply disruption carries enormous weight. The fire did not need to be fully burning. The smoke alone was enough. And on that Sunday evening, two separate smoke signals were now rising simultaneously. PAXG from the digital markets, Mexico from the physical world. But the third signal was buried deep inside a market that most people trust without ever questioning. There is a room that most people never enter, not physically, but financially. It is called the COMEX, the Commodity Exchange of New York. It is where gold and silver contracts are bought and sold daily by institutions, banks, hedge funds, and trading desks that collectively move billions of dollars with quiet precision. Most retail investors never look inside this room. They trust that it functions fairly. They assume that the prices appearing on their screens reflect genuine supply and demand. And most of the time, that assumption goes completely unchallenged. But on this particular Sunday evening, something inside that room had been quietly building for weeks. Something so statistically unusual, so historically unprecedented, that veteran analysts who had spent decades studying COMEX delivery cycles were struggling to find a comparable precedent. They could not find one, because one did not exist. Here is what the data revealed. With 4 days remaining before the last notice date on the February gold contract, the remaining open interest represented over 436,000 ounces of gold, approximately 13.5 tons. To understand why that number is extraordinary, consider this single comparison. At the same stage of a typical delivery cycle, the average open interest sits at a fraction of that figure. This number was 24 times the expected level, not double, not triple, 24 times. But the anomaly did not stop there. The February contract's open interest was actually larger than the upcoming March contract. In commodity markets, that sequencing is structurally backwards. Contracts approaching expiration are supposed to shrink as participants roll their positions forward into future months. Instead, the February contract was growing heavier while March remained lighter. That pattern had likely never occurred before in the recorded history of this market. So what does that actually mean in plain language? It means that somewhere inside the COMEX, a short position of enormous size had been holding since first notice day, waiting for an exit, hoping that buyers would disappear, hoping that liquidity would return. Instead, volume on Friday had collapsed to just 134 contracts. 134. In a position measured in hundreds of thousands of ounces. That is not a liquid market. That is a trap. And the uncomfortable question that every serious analyst was now asking behind closed doors was devastatingly simple. Does this short actually possess the physical metal required to deliver? Because if the answer is no, the consequences do not stay inside that room. They spill outward, into spot markets, into physical dealers, into the price that every silver investor on Earth wakes up to see on their screen. 3 signals had now aligned. PAXG pricing gold higher before Western markets opened. Mexico introducing genuine uncertainty into the world's largest silver supply chain. And COMEX quietly containing a short position of historically unprecedented scale with no visible exit. But there was a fourth dimension to this story. One that most Western analysts were sleeping through entirely, because it was happening in a time zone while they were still in bed. And that is exactly where part 4 begins. There's a clock that serious commodity analysts never stop watching. Not the clock on Wall Street, not the clock in London, a clock set to China Standard Time. Because when Shanghai speaks in the physical silver and gold markets, the rest of the world eventually listens, whether it wants to or not. On this particular weekend, Shanghai was silent, not because nothing was happening, but because its markets were closed, resting through a holiday period while the rest of the world's financial machinery continued turning quietly in the background. And that silence, that temporary absence of the world's largest physical metals market, was itself a critical variable that every short-term trader needed to understand before Mondays opened. Here is why the absence matters so profoundly. When a major market participant steps away from a trading session, the remaining participants do not simply fill that vacuum proportionally. Liquidity thins price movements that would normally be absorbed smoothly across deep order books. Instead, travel further on less volume. A move that might represent genuine demand in a fully liquid session can appear dramatically amplified in a thin tape. And equally, a reversal can arrive with the same sudden, disproportionate force. This creates a specific danger for those who misread momentum. On a Monday open, where Shanghai was offline, a gap higher in gold or silver would not automatically confirm that institutional demand had arrived. It might simply reflect the mathematics of a thinner market. Where smaller orders move prices that larger orders would barely shift under normal conditions. The experienced analyst understands this distinction. The impatient trader typically does not. But here is where the Shanghai story becomes truly significant, because Shanghai was not returning to a normal landscape. It was returning to a landscape that had been fundamentally altered during its absence. Mexico had destabilized. PAXG had flashed a forward signal that Western institutions were now processing. The COMEX February contract had entered territory that veteran analysts had no historical reference point to navigate. And the physical silver premium that Shanghai had already been running before it closed for the holiday had been signaling for weeks that real buyers in China were paying above market prices to secure actual metal. Not paper promises, not futures contracts. Physical metal. That premium does not develop accidentally. It develops when the entities closest to real supply, the refiners, the industrial buyers, the sovereign institutions, begin calculating that what is available today may not be as available tomorrow. Shanghai had already been sending that message before it went quiet. When it reopened on Tuesday, it would be sending that message into a world where 3 additional alarm signals had fired during its absence. The question that serious analysts were now sitting with was not whether Shanghai's return would matter. It was whether the market was prepared for what Shanghai might say. A market already tight, a short already trapped, a producer nation already destabilized, and the world's largest physical exchange walking back into the room. What happens when all 4 walls close in at the same time? There are moments in history when the rules that govern the entire financial world change. Not overnight, not with a single announcement, not with a headline that appears on the front page of every newspaper simultaneously. They change quietly, gradually, in the language of balance sheets and reserve allocations, in decisions made behind closed doors by central bank governors, in data points that surface months later in reports that most people never read. And by the time the majority of the population understands what has changed, the transformation is already complete. That is precisely what is happening right now. And the data is not hiding it. The data is broadcasting it. For those who know where to look, consider this single statistic first. The United States dollar's share of global currency reserves has fallen to its lowest level in 32 years. Not a modest decline, not a temporary fluctuation that corrects itself within a quarter. A sustained structural multi-year erosion of the dollar's dominance in the reserve portfolios of central banks across the world. At the same time, central bank gold holdings have now exceeded their treasury holdings. For the first time since the mid-1990s, these 2 data points did not arrive accidentally. They arrived together because they are telling the same story. To understand that story, one must go back to a single event, 2022, when Western governments made the decision to freeze approximately $300 billion in Russian sovereign reserves held in Western financial institutions. In the immediate media coverage, that decision was framed as a powerful financial weapon deployed against an adversary. What was not discussed with equal prominence was the message that decision sent to every other nation on earth watching from the outside. The message was precise and unmistakable. Dollar reserves held in Western institutions are not unconditionally safe. They are conditionally safe. Safe until they are not. Central banks do not ignore messages of that magnitude. They act on them, quietly, methodically, over quarters and years, rather than days and weeks. And the acting looks exactly like what the current data is showing, a steady rotation away from dollar-denominated treasury holdings and toward an asset that no government can freeze, no institution can seize, and no sanction can reach, physical gold. But here is where this monetary shift connects directly to the signals firing on that Sunday evening. As central banks accumulate gold instead of treasuries, the inflation that American deficit spending has historically exported abroad through treasury demand begins returning home. Foreign buyers are no longer absorbing that supply at the same rate. The mechanism that allowed the United States to run persistent deficits while keeping domestic inflation partially contained is quietly losing its efficiency. And the assets that have historically absorbed monetary disorder when that mechanism breaks down are precisely the assets that PAXG, Mexico, COMEX, and Shanghai were all signaling simultaneously. This is not a theory constructed from speculation. This is arithmetic constructed from public data. And arithmetic does not negotiate with disbelief. It simply continues calculating until the answer becomes impossible to ignore. But beneath even this monetary foundation, there is a geopolitical layer that markets had quietly stopped pricing. There is a particular danger that experienced analysts fear more than any market crash, more than any sudden liquidity crisis, more than any unexpected central bank decision. It is the danger of a risk that does not disappear, but simply becomes quiet. Because when a risk becomes quiet, markets stop pricing it, institutions stop hedging against it, traders stop factoring it into their positions, and the world collectively exhales, as though the absence of noise is the same thing as the absence of threat. It is not. On that same Sunday evening, while PAXG was flashing its premium signal, while Mexico was generating supply uncertainty, and while COMEX was containing its historically unprecedented short, a separate development was sitting in the background of every financial terminal on Earth. Not trending, not headlining, but present. The situation involving Iran had not resolved, it had reclassified. There's a critical difference between those two words that most media coverage consistently fails to communicate. Resolution means the underlying tension has been addressed, negotiated, and structurally reduced. Reclassification means the tension has simply moved from the front page to the background, from urgent to ambient. The risk does not shrink during that transition. Only the attention shrinks. Here is what the data was actually showing beneath the diplomatic language. The United States had signaled a degree of acceptance toward Iran, maintaining uranium enrichment capabilities. In the immediate coverage, that signal was widely interpreted as a move toward de-escalation, a cooling of tensions, a diplomatic opening that reduced the probability of direct military confrontation. But experienced geopolitical analysts were reading the accompanying data far more carefully, because simultaneously, significant military assets had been moving toward the Middle East region, in numbers not observed since 2003, aircraft carrier groups, logistical support infrastructure, forward positioning of hardware that does not travel cheaply or quickly, and does not retract automatically simply because a diplomatic statement has been issued. This is the fundamental asymmetry that markets consistently misprice. Diplomatic language moves at the speed of a press release. Military hardware moves at the speed of ships and aircraft. And when those two timelines diverge, when the words say one thing and the positioning says another, the honest analyst does not follow the words. They follow the hardware. Because hardware positioned in a region, it does not reduce strike probability to zero. It reduces response time to near zero. The capability remains present. The optionality remains active. And markets that have exhaled and stopped pricing that tail risk are markets that have made themselves vulnerable to a sudden, sharp repricing the moment that background risk returns to the foreground. Precious metals have a centuries-long history of absorbing exactly that kind of repricing event. When geopolitical tail risks that were quietly accumulating in the background suddenly demand to be priced into every asset class simultaneously. Gold and silver do not wait for consensus. They move on the first recognition of what was always there. 6 separate signals had now converged on the same window of time. PAXG, Mexico, COMEX, Shanghai, monetary regime shift, geopolitical reclassification, each one serious in isolation. Together they were forming a pattern that serious capital allocators could not responsibly dismiss. But there was still one dimension of this story that had not yet been examined, the dimension that directly determines how price actually moves. Not why it should move, but precisely where it moves to, and what stands in its way when it gets there. That is the conversation Part 7 was built to have, and it begins with a number that the tape had already identified long before Sunday evening arrived. There is a language that markets speak. That has nothing to do with headlines, nothing to do with geopolitical briefings, nothing to do with central bank statements or diplomatic press releases. It is a language written entirely in price, in levels where buyers historically appeared, in zones where sellers historically defended, in the memory that markets carry forward from every session that came before. And for those who learn to read it with discipline and patience, that language tells a story that no analyst on television will ever narrate for them. On that Sunday evening, while every macro signal was converging simultaneously, silver's tape was telling its own precise and structured story. Not a story of chaos, not a story of random movement, a story of architecture. Levels stacked above levels, objectives sitting above objectives, each one representing a specific test that price would need to pass before the next chapter of that story could be written. The first level that serious tape readers had identified was $86.30. This was not an arbitrary number selected from a mathematical formula. It was a price that the market itself had previously recognized as significant, a prior weekly high, a level where price had previously reached, paused, and retreated. That kind of market memory does not erase itself simply because time passes. It waits. And when price approaches that level again from below, the same tension that existed during the original encounter reactivates. But what made $86.30 particularly significant on this occasion was not just its history as a prior high. It was the fact that a separate technical measurement, derived from an entirely different analytical method, was pointing toward the exact same price. In technical analysis, that convergence has a specific name, confluence, and confluence carries a weight that single indicators simply cannot match. When two separate roads lead to the same destination, the destination becomes more than a coincidence. It becomes a target. Above 86 from 30, the tape revealed something more complex, a resistance zone spanning from $87.20 to $89, and this zone demanded a specific kind of respect that the 86.30 level did not require. Because this was not simply a prior high to be tested and cleared. This was a range, a region of price where sellers had historically gathered in sufficient concentration to absorb buying pressure and push price back below. Here is the critical distinction that separates experienced traders from impatient ones. A resistance zone is not conquered by approaching it slowly. It is not conquered by grinding through it over multiple sessions. It is not conquered by consolidating inside it while momentum gradually exhausts itself. It is conquered by force, by price entering that zone with sufficient volume and conviction that the sellers who have historically defended it find themselves outnumbered before they can organize a response. Consolidation inside that zone does not signal strength. It signals that the buyers who drove price there are running out of the energy required to complete the move. And energy in a commodity market comes from a very specific source. It comes from the alignment of physical demand, structural scarcity, and macro catalyst. On that Sunday evening, all three of those energy sources were present simultaneously. Physical demand signaled by Shanghai's persistent premium. Structural scarcity signaled by COMEX registered inventory, sitting well below delivery demands. Macro catalyst arriving from Mexico, PAXG, and the geopolitical background simultaneously. The tape was not predicting. Tape never predicts. It simply describes the conditions under which specific outcomes become more or less probable. And the conditions that Sunday evening were describing were the conditions under which a market carries enough energy to enter a resistance zone with force rather than fatigue. Whether that energy would materialize into Monday's session was a question only the open could answer. But the structure was there, the architecture was intact, and 6 separate signals were all pointing toward the same narrow window of time. There was only one remaining question. What should serious decision makers, business leaders, and capital allocators actually do with everything this analysis had revealed? There is a difference between information and intelligence. Information is data that arrives. Intelligence is data that has been understood, contextualized, connected to other data points, and translated into a framework that allows serious people to make serious decisions. Most people who follow financial markets accumulate information. Very few develop the discipline to convert that information into genuine intelligence. This analysis was built for the second group. So here is what the intelligence picture actually looks like. When every signal from this Sunday evening is placed side by side, PAXG flashed a $50 premium before Western markets opened. Mexico, the world's single largest silver producer, entered genuine instability at a moment when physical silver was already running a structural deficit. COMEX contained a short position of historically unprecedented scale with no visible exit and collapsing liquidity. Shanghai was preparing to reopen into a fundamentally altered landscape after its holiday absence. The global monetary regime was visibly rotating away from dollar-denominated reserves toward physical gold at a pace not seen in 3 decades, and a geopolitical risk that markets had stopped pricing was still physically present in the form of military hardware positioned across a volatile region, 6 signals, 1 window of time, and a silver market that was not priced for any of them. Now here is what serious decision makers must understand clearly. This analysis is not a prediction. Markets do not owe anyone a particular outcome simply because the conditions for that outcome are structurally present. Howard Marks said it with precision. Being right about the direction and being right about the timing are 2 entirely different skills. History is filled with analysts who identified the correct thesis, and still lost because they confused those 2 skills into one. And what this analysis provides is something more valuable than a prediction. It provides a map of the structural conditions as they exist right now, the levels that matter, the signals that are active, the risks that have not been priced, and the sequence of events that serious capital allocators should be monitoring as each one develops or fails to develop in the sessions ahead. For the business community watching this, for the aspiring entrepreneurs building their first understanding of how macro forces affect real capital, for the young decision makers who are learning that financial markets are not random, but are instead deeply structured systems that reward those who study them. The lesson of this Sunday evening is straightforward. The alarms do not always ring loudly. Sometimes they ring quietly in the form of a $50 weekend premium on a gold-backed token, in the form of military movement in a country most investors never think about, in the form of an open interest number that has no historical precedent. The ones who hear those quiet alarms and take them seriously before the crowd does are not lucky. They are prepared. Preparation is not built in the moment of crisis. It is built in the quiet hours before the market opens, in the discipline of studying structure when others are distracted by noise, in the habit of connecting dots that the financial media leaves deliberately unconnected. PAXG and Mexico were sounding alarms. Silver was approaching a resistance zone that required decisive force to clear, and the world's monetary architecture was shifting beneath every asset class simultaneously. The question was never whether these signals mattered. The question was always whether the right people were paying attention. Now they are, AO and AG, where gold and silver speak, and serious people listen.